Hey guys, hope you are all doing well and having a magnificent day so far. Today, we have a crap ton to talk about. A series of developments have taken place that have the possibility of setting the global economy, and therefore the markets, back to new lows. Of course, this is just a possibility of a worst-case scenario, and I will do my best to give an objective measure of odds of these things panning out so that you can have a realistic set of information by which to abide and make uniform decisions. However, before we begin, I have got to sponsor my own Discord for a minute. In fact, let me not even tell you, let me show you what we've been doing these past couple of days. We have been day trading the absolute crap out of SPY, running high on the momentum and entering at the key levels to yield some of the best gains possible. I mean wholeheartedly when I tell you that if you are a day trader, or looking to learn and start day trading, to look no further than my own Discord and allow me a chance to show you guys firsthand what it's like at no cost to you. Simply tag me in a message on the Discord and let me know if you are interested in these day trade alerts. As long as you got a computer or phone and working fingers, you too can participate with us in extracting the best plays every single day. With that said, let's start today's segment. You know, last year, markets were rocked when news broke out early around February that Russia had begun their first major invasion into Ukraine. The world panicked, stocks plummeted and continued doing so as Europe faced an energy crisis that saw huge demand rise for energy companies and inflation to skyrocket. I guess it would have been too much to ask for 2023 to save us from another similar catastrophe, because yesterday Israel decided to carry out a drone operation that struck military plants in Iran. Unless you have been educationally or internet deprived for pretty much your entire life, you know very well that there has always been tensions between these two Middle Eastern countries, but the actions taken by Israel could result in significant consequences that could further destabilize yet another important region. Already the corporate media shills are working hard to convey a narrative that even if war were to break out between these two hostile nations, the effects it would have for the rest of the world are minor. For some reason, as I read analyst after analyst spout the same putrid garbage, I began to experience mild PTSD flashbacks of 2022, where I was told, no, I was assured by the same analysts, that the United States economy would remain strong due to our limited exposure to the energy crisis taken place in Europe. Yet, here we are in 2023, with inflation eating into our ability to feed and live under a roof. I find it hilarious that they are so confident that the effects of a potential, and even nuclear, conflict developing in the Middle East will have little to no consequences for the global economy, including American of course. Depending on how things pan out from here on out, there is no way to measure the impact that open attacks between these two nations could have on the life of everyday Americans. We could even see inflation worsening as a result of this. American economics are still deeply tied and embedded with certain nations in the Middle East. For crying out loud, did the corporate media forget OPEC exists, and how this cartel literally control oil prices in the entire globe? It's hilarious they think your quality of life cannot be further tainted if a conflict in the Middle East were to erupt. Moving past this horrendous development, there has been a brewing problem I had alluded to in previous videos, but one that is continually growing and being ignored. This one has the chance to offset whatever market rally stocks have been enjoying since the last market bottom, with great potential to dig us deeper into a bearish market and one that could offset a market crash. Ladies and gentlemen, Americans' credit card debt is piling up too high, and it's going to prove to be a very costly crisis that the government and Fed will have to consort with. The average credit card user is carrying a balance of $5,474 last fall according to TransUnion, which was up from 2021. More Americans are having to lean on their credit cards to survive the persistence of inflation and all the high prices we have had to take on. This also marks a reversal from the first year the pandemic hit, when Americans were able to actually pay down some of the credit card debt due to the government relief payments. Looking more into details provided by Bankrate, the share of credit card users who carry a balance has increased from 39% to 46%. Almost half of cardholders are carrying debt from month to month. Lower-income cardholders are obviously more likely to carry a balance, but the shocker came at the high number of people who make over six figures also beginning to carry balances. 37% of people making over $100,000 a year or more are not paying their credit cards in full. This is actually a bigger problem than you think. Let me explain to you why real quick. The average interest rate on credit card debt has been soaring to nearly 20%, from just over 16% at the beginning of last year in 2022. This represents the largest one-year increase in the 4 decades Bankrate has been tracking rates. We also know the Fed is not intending on stopping out their hawkish stance, so this number is likely to continue climbing more and more. This means that the cost of carrying a balance on your credit card will go up as well, representing yet another financial burden for most Americans. Funnily enough, after a brief survey, Bankrate found out that more than 4 out of 10 credit card holders don't even know what their interest rate is. But it wasn't just Bankrate that is sounding alarms. A survey by NerdWallet found the average US household carrying credit card debt that is 29% higher than a year earlier. 1/3 of the poll they carried out found that 14 million Americans owe more than $10,000 in credit card debt. Credit card debt foreshadows the amount of people that could begin to default on payments if the economy doesn't quickly transition. Imagine if tens of thousands, if not millions of people, all begin defaulting on payments more and more month back to month. The impact of this alone will offset whatever bullish sentiment the markets may have. And yet, there are as much more negative developments taking place that overshadow credit card debt. Economic data is out and the results are putrid at best. The main driver of the United States economy, which is consumer spending, is finally beginning to weaken. Retail purchases have fallen in 3 of the past 4 months. Spending on services, including rent, haircuts and the bulk of the typical bills Americans get per month, was flat for the month of December after you adjust it to inflation. This means last December was the worst monthly reading for nearly a year. Sales of existing homes in the US fell last year to their lowest level since 2014. The auto industry posted its worst sales year in more than a decade. The share of monthly income Americans set aside for savings was just 3.4% in December, which was down 7.5% from a year earlier and from a record high in April 2020. Remember that consumer spending accounts for roughly 70%, or nearly 3/4, of the American economy. Without spending, there is no economy. Right now, economists are hard at work trying to decipher the key to stabilize American spending, which, if it doesn't, will all but guarantee a collapse and market crash. The Goldman Sachs CFO said the bank is seeing early signs of consumer credit deterioration, with Bank of America following up with a warning saying the U.S. economy will lose 175,000 jobs in the first quarter of 2023. We have already witnessed tens of thousands of layoffs across the biggest companies in the world in the financial and tech sector, and much more is to follow according to certain analysts. So, when we look at these facts and compile them all together, we have to conclude that it is way too premature to be so bullish on the stock market. I mean, yeah, unemployment numbers have been great and so were GDP numbers. More am I also seeing people say the worst of this recession is past us and that the Fed is maintaining significant control as CPI numbers climb down. Yet, I remain far from convinced in America's recovery when data clearly shows Americans are literally on the edge of defaulting on their debts. Sales for cars and houses are down, credit card debt at extremely high levels while savings continue to worsen. This does not inspire confidence in the most important gear of the U.S. economy, which is spending. It warrants uncertainty and deep questioning of what could happen in the coming months if Americans don't catch a break. The United States cannot endure another economic spiral where the middle class once again received the end of the stick. The perverse effects that are being ignored by economists that allowed prices to rise even as earnings remained stagnant made maintaining a lifestyle near if not completely impossible for a significant amount of Americans. Ordinary families are being robbed their spending power, and yet monetary policymakers continue to spat on our faces with lies after lies that we are somehow getting a good deal on prices. Research showed that in 2021 alone, the cost of living rose 6.1% for middle-class families even as nominal wages for the typical full-time worker rose only by 1.4%. The true cost of living for middle and lower-income Americans has risen 50%, more than commonly used measures like the CPI. These shocks to the economy and everyday lifestyles for middle-class families will prove to have both short-term and very long-term consequences on spending behavior in the time it takes to fully recover. I am not bearish because I want the economy to dip to catch a better price. I am bearish and will remain so because Americans continue to hold the burden of carrying this economy upright, and the issue is that the foundation of this strength is weakening at such a rapid pace that even the brightest of the financial sector are beginning to worry. Moving on, AMC stock dropped after news from the company came out late on Friday. AMC said in a securities filing that it plans a March 14 special meeting of shareholders in which it hopes to usher through an overhaul of its capital structure. They are using the rationale that their push to convert their APE units into common stock is a massive opportunity to battle and eliminate the high amount of debt the company has. Now, my opinion on this is well known, as I devoted a while video to expressing my discontent with the management at AMC. I will give my thoughts on this from both an objective standpoint and as a shareholder. To me, it is clear that AMC is looking to rid themselves of debt as soon as possible. They are looking ahead and see the multiple tranches of debt and possible high interest rate environments they might have to endure, which could significantly prolong their inability to turn free cash flow positive. It is worth nothing that if the proposals fail, there will be no conversion of APE units into AMC common shares, and APE units will potentially decline to a price much lower than it has ever been, which will drag AMC shares even further down than what they already are, and this is the main crux of the problem shareholders face. I am not going to be nice about the following statements, so buckle up. Ever since APE units were introduced and debuted back in August, I warned you guys that it was a bad move. Yes, I understand AMC needs to make money, that is not the freaking issue whatsoever. The problem here is that management at AMC are so creatively bankrupt that the only way they found to generate revenue was through indirectly manipulating their stocks so as to derive value directly from shareholders' pockets. APE's purpose was simple, to make money from you. I think of it as them forcing a donation quote unquote. Now, obviously AMC shareholders for the most part were okay with this since they held through it under the belief that it was a deed that had to be done in order to save their company an overall investment. Yet, even with APE shares, AMC management still somehow managed to screw it up. The amount of money they raised to help pay off their debt wasn't even $1 billion, much less $5 billion. They managed to launch these units and sink the value of AMC only to derive a tiny bit of money in the end that will not make any significant dent on their total debt. If anything, APE should have been launched back in 2021 at the peak of AMC's popularity. I am sure the momentum alone would have made this venture a great idea that would have eliminated debt easily, further strengthening the fundamental valuation of AMC, which would have added much value to investors themselves, and the company would be generating money to actually reinvest in themselves in new ventures. Instead, AMC management decided to issue this now during a recession when meme stocks are at their lowest popularity. I must take a moment to remind you guys, I strongly believe AMC can survive out of all of this. I think theaters can and will survive, and that if new ideas were introduced that help enrich both their ability to create exclusive content for their theaters via the making or acquisition of a small movie production company, they could definitely make it long term. My frustration lies with the AMC management, who launched these units, transferred millions of dollars from shareholder pockets directly through theirs while providing absolutely no value at all. Again, what they will make from converting APE units into AMC common stock is absolutely pathetic. It will not make any significant advancement to their debt ratios. I believe in the value of AMC as a company, but I am finding it really to cope and understand the lack of creativity by AMC's management team. We will see what happens in the end and if they get the approval they seek, which by all accounts as far as I can see will be a resounding yes. In regards to GameStop, which has been a while since I covered, all I am waiting from them is DRS results on their next earnings. If the rate at which people DRS their shares slows down once again, it will not provide relief to investors whatsoever. The stock has been enjoying a lot of volatility lately, though it has been unable to maintain and hold the price levels. I got a couple requests from people to discuss where I see the stock market going. Right now, it's a wait and see kind of deal, to be honest. As we have seen, there are way too many events and changes happening around the world which can greatly affect markets. Right now, the Fed and earrings seem to be the two factors which will green light a market bull run or a market dip. Past that, we are sort of guessing our way through uncharted territory by using CPI data as the single most important barometer by which to measure economic strength and recovery, so when those come out better than expect, the market runs as bullish sentiments is reaffirmed. If they come worse than expectations, bears rejoice and miss no opportunity to remind the world that things are not good and that the markets continue to be way overvalued, which, to be honest, is also kind of my own take on things as well, so I do agree that I may have a bit of a bias, though I always try to provide a clear and objective reason as to why it is so that you don't follow blindly. My own take is that there are way too many uncertainties for the stock market to be this strong, but I understand bulls and their belief that the bottom was already reached. Inflation continues to come down and credit card debt comes down with increased consumer spending, and the rate increases don't affect businesses too much, then I will definitely reassess my bearish thesis and quickly switch to become bullish. However, until this happens, I will continue to hold my bearish options as my opinion is simply based on the overall perception of all economic data, not what I wish it to be or a forecast in the random about what I want to happen. And that is all I have for you guys today. Seriously though, come check out my Discord already. The day trades have never been this strong. If you are a day trader or want to become one, and wish to have a reliable guide with strong alerts, then please give my Discord a chance. Look for yourself at the results of our success. All I want is for you to see if it's for you. Beyond that, I will see you later in the week for another video. Thank you for watching this video through its end. Have an amazing rest of your day and to the moon.